Hi, what if I told you that you could make $8,400 in a month or $4,200 in a month, and that would be about a 3% or an 8% return on your investment, and you'd have a 7 out of 10 chance of doing it on NVidia if you like that stock. Stay tuned because I'm going to go through 3 examples of how we can do that using in-the-money covered calls. Here we go. We've got NVIDIA. You know it's the #1 performing stock of most stocks this year. There's a couple that have outperformed it, but NVIDIA seems to be the one that everybody's talking about. So let's take a look at this chart. Now this chart, you could see where I put these little red lines in here. Those are little base positions, like little bases, I say. And so the stock, what stocks normally do, if you can look at any chart, and they normally, if they're on an uptrend, they go up and then they base. And then they go up and then they base, and then they go up and then they base. Now, each one of those is called a base. And if the base moves up 20 to 25%, you set up a new base number, right? So the first base is base 1. If it goes up more than 20, 25%, it's base 2. Then if it goes up more than 25% again, it's base 3, and so on, right? After base 3, it's a late stage base, or actually during stage 3. I don't even like to buy stage 3s. NVIDIA is in a stage 4 base, or a stage 3, depending on how you count your bases. But to me, it's a stage 4 base, which means it's pretty late. It's had a hell of a run. Look at this thing. It's gone from just over $10 to $140, which is a 1,400% return in just, what is that, about a year and 2 years, about 2 years. Okay. Well, that's a lot better than the 10% that the S&P 500 typically does, or 9% or whatever, and it's certainly better than inflation. So here's my thing. I like NVIDIA. I really do. I think they're the future of everything. Except I've noticed that there's a disconnect between a stock and a company. So the company doesn't always do what a stock does, like whether you think you know what it's going to do or not. A company does something and the stock does something totally different a lot of times. Now, the stock will normally anticipate the moves that the company is making, and NVIDIA is making some amazing moves. However, let's not get greedy here, right? It does look like it's breaking out. In fact, it's right at a breakout point here today at around 139, which is really, it's right near the top of its all-time high. That 140 spot is where this thing is going to break out. Now, if it breaks out, it needs to break out on gigantic volume in order to keep running. And I don't see that in NVIDIA. But I still want to be part of the stock. I mean, I still think it's a great story. I still think it's bullish. And covered calls and even selling puts are bullish strategies. So if I could show you here how we're going to do covered calls on these, and it's still going to be bullish, but it's going to give you a bunch of protection, I hope you'd still be interested, because this is my favorite way to do covered calls. They're called in-the-money covered calls. And this is how I build all of my strategies. I start with in the money. I eventually may move to out of the money or at the money, but in the money is my core strategy. And I'll show you why, right? So you see that this stock is right at a breakout point, which means in a late stage base, it could fail. Now, 40% of all breakouts fail, which means if this one fails because it doesn't have enough volume, it's going to go back down to the 50-day moving average, or maybe even go down to this 200-day moving average, which is right now around $100. Well, that's a pretty big move down. That's a 40% move down. We don't want to sit through that, do we? Well, I'm not saying it's going to go down that far, but I am saying that it could drop a little bit here. It just did this week. It just dropped 7-8 points this week, and now it's back up to its all-time high. So what does that mean to us? Well, we want to buy the stock. We're bullish on the stock. We don't want to short it, for sure. Don't short it, please. But you want to buy the stock, and you say, okay, I'm involved in buying the stock. Well, you see the stock here is right around 139 bucks, which means you got to invest $139,000 to own 1,000 shares. So that's the example we're going to use, about 139,000. If you don't have 139,000, lop off a 0 or cut it in half or do something. I can't do the math for everybody. I know I get a lot of people going, I'd love to see you do 250,000. I'd love to see you do $1 million. I'd love to see you do 25,000. I just picked some numbers that I think that a lot of people would like. Right now, the number happens to be 139,000 because that's what the stock is at. And if we buy 1,000 shares, we're talking $139,000, okay? So we're talking about buying 1,000 shares of NVIDIA. And then what we're going to do is we're going to find a call to sell against. Now, if you haven't done covered calls, basically you're giving somebody else the opportunity to take your stock away from you at a certain price before or at a certain date. Okay, it's a covered call. If you need to know more about that, I've got videos on my channel. Other people have videos on their channels. You can go to the Options Clearing Corporation. There's videos all over. Your broker has videos on covered calls. Now, everybody can teach you covered calls. What happens after the covered calls and the strategies and the trading systems and the trading plans and what's up in between your ears, that's where everything happens, right? It's not just buying a stock and selling a call. I'm going to show you that, and I'm going to show it to you for free. How about that? So you're going to buy that 1,000 shares, and then what you're going to do is you're going to turn around and you're going to sell the call. Now, when you sell the call, you get money. When you sell anything, you get money. So what we're looking at here is, instead of doing these 140s or something where the stock is going to break out, right? You know, and it could. We don't know what it's going to, but let me just show you these 140s. If you look at these 140s, you're talking about a 51% chance of it being in the money, okay? Which means there's about a 49% chance or 48% chance of being out of the money. Well, that's okay. If it doesn't fall too much, that's an ideal trade. But the more you go in the money, the more solid your position is, the more guaranteed. I hate to use that word in the stock thing, but guaranteed in quotes, let's call it, okay? So as I go down here and I go deeper into delta, I increase my chances. Delta is basically, you can substitute it for chances of the stock being in the money at expiration, okay? So we're looking at a strike that's about 28 days out from now, okay? So that's a monthly call. And so we're going to look, instead of doing the 140s, we're going to protect ourselves with the 130s. And you go, and that's got a 71% chance of expiring in the money over 130. Well, it's at 139 right now, so it's a pretty good chance it's going to be over 130 within a month, right? Unless we get a crash in the market. Now, you might say, Mark, well, why would I want to do that? Why wouldn't I go do these 145s if you think it's going to break out? Well, remember I said it's in a late stage breakout. If it's in a later stage breakout, it's got a lot of risk, a lot more risk to the downside than if it were, say, in a stage 1 or stage 2 breakout. I don't like to play that game where I'm trying to guess. I'm not Nostradamus, even though I know NVidia will go up over time, or I think it will, right? I don't know anything. But I think it's going to go up over time. I'm still not going to gamble in the next month and say, well, I'm sure it's going to go up, because I'm not sure of anything. What if I instead got myself a 71% chance that it's going to be in the money, therefore giving me the profit that I predict? That's a 7 out of 10 chance that I'm going to be right and get the profit that I predict, right? So let's see what the profit is I predict. Let's start with it. Well, it's $4.42, which means it's $4,420 for a 28-day call. So I get that money today no matter what. And as the days go by toward expiration, that becomes more and more, less and less valuable, right? It eventually goes to zero on the expiration date. That means I get to keep the whole $4,420 no matter what. Well, that's a pretty good deal. I mean, if I do an at the money, I keep $700 or $7,500 instead of $4,400. That's more. But if the stock goes down below 138, now I'm starting to lose money on the stock. This way, I sell the call for $13.40. Okay, $4.42 of that is what I call juice. That's time premium. That's the profit we're going after, is that $4.42. So I sell for $13.40. What does that do? It gives me a cushion from where the stock is now of 138.98, let's call it 139. And the cushion is, I get, what did I say? $13.40 on the downside. So this thing can go to 126-ish, okay, 125 to 126, before I even start to lose money. That's only a 30% chance of losing money. I get all this cushion. That's yummy, right? When you get a 7 out of 10 chance of being right, you're going to take those probabilities all the time, right? So here's what we do. Here's the math. You buy the stock for $139. It's $139,000, okay? Then you sell these 130 calls and put $1,300, well, you're going to put $13,400 into your account, okay? But a lot of that is in the money amount, so it doesn't really count because it offsets with the stock as long as it stays above that 130 strike price, okay? But you do get to keep the $442. So that's what we're after, is this $442. $4,420 on this trade, as long as the stock stays at or above 130 for 28, by the 28 days from now. Does that make sense? So you're going to be picking up about 3% or $4.42 on this entire investment. Okay? 3% for 28 days comes out to be 41% annualized. Okay? Now annualized just means that you can do the same trade equivalently 11 more times this year. And, we got a 7 out of 10 chance of that happening. Now, anything can happen. Market go down. Right now, the market's green. I think it's green, extended green, so it means it could correct. That's why I'm not really playing this that bullishly. Although most of the time I love breakout stocks and doing covered calls on breakout stocks, I don't play it as bullishly as if it were in a first or a second stage base. Now, Mark, I don't have $139,000, or Mark, I don't want to do $139,000 on that. That'll be my whole portfolio, or that'll be too much of my portfolio. Okay, well, there's an app for that. It's called buying the leap instead of buying the stock. So you could go out 6 months. I'm going to give you an example here in a second. And instead of buying the stock, we're going to buy the leap. So here are the leaps 6 months out. Now, they're not leaps. Leap just means long-term equity anticipation, whatever. It doesn't mean, it means long-dated options. So this isn't that long. It's only 181 days, but I'm going to go out to the April 25s, and instead of spending 139,000 to control 1,000 shares of this stock, NVidia, what I'm going to do is I'm going to go here and I'm going to look to where I have a 90 delta. A 90 delta means I've got a 90% chance of it expiring in the money. I want it to expire in the money. Right now, it's got a premium of $55 for the 90s, okay? $5 of that is juice. So how do you look at that number? Well, instead of spending $139 for a share, you're going to spend $55 for a share, actually just a control of that option. And so that's cheaper, right? It's like less than half the price. So you can buy twice as much, at least, of these 90 delta 90 strike price calls for 55 bucks. $5.19. Now you're not getting this because you're buying it. This is a cost. You can amortize that over the next 6 months. $5.19 divided by the next 6 months is, I don't know, what, 80 cents, 85 cents, something like that. So it's costing you, because there's never anything free in the market, it's costing you 85 cents a month, or roughly 20 cents a week, to own these leaps, to own these long-term options, okay, that expire next April. So how does the math work on that? Well, it's simple. Instead of costing you $139,000 and getting $4,420 a month, you're going to only spend $55,000 and get $4,420 per month, right? Now, if you do that on $55,000, the $4,420 per month is an 8% return. And if you annualize that, guess what it is? It's 96%. That means you can do it over and over again 11 more times. Now, there's a little slippage with Delta and owning the long call, so don't be writing comments like, Mark, you didn't factor in the slippage. Yeah, I'm giving you a rough idea on how to do this trade. Give or take a few percent here, we're talking about a pretty good trade, 96% annualized or 8% for 28 days. Very not bad, right? Now, there's one other way that you could do with the same amount of money. This is the third example. So instead of buying the stock for $139,000, you can spend $110,000 to buy 2,000 shares. Okay, so now you can turn 2,000 shares or $110,000 into $8,840 a month, which is $4,420 for 1,000 shares. So double that, $8,840 for 2,000 shares. Now we're talking about $8,000 a month. Could you use an extra $8,000 a month? I know I could, and I like that. So that's why I like this trade. First of all, on the top, on the short side, on the covered call side, you got a 70% chance of being right. You've got a 71 delta or 70 delta. That means you got a really good chance of being right and keeping that $4 worth of juice without having the stock go below the strike price. All of those things work out to be pretty good. But if you want to juice it up a little bit, you can use leaps. And now instead of getting a 3% return, you get an 8% return. Or you could still have less money invested than the $139,000 and get 2,000 shares using the same leaps, but just doubling the position with 20 contracts, right? Contract is 100 shares. So does that make sense? I hope that makes sense. Now, most people don't even understand that this is even possible in the markets, right? And I'm just showing you, there's 3 examples here of you want to be really conservative, buy the stock. You want to be a little bit more risky, buy some leaps and only spend $55,000. You want to spend roughly the same amount. It's still risky because it's leaps or it's long-term options, and you've got to manage those on the downside, and there's a whole bunch of repercussions that we could talk about on managing them and rolling them down and doing all those things. But if you're talking about just trying to look at the income, and I try to get all my students to focus on the income, you're talking about a trade that makes you $8,800 a month. I want to be a little bit safer, so I'm going to do an in-the-money call. Now, a lot of people are like, I don't understand. Why would you go in the money? Well, if you could do in the money, if I could tell you that you could make 3% a month, okay, for 12 months, you're talking about, 36%. How many investments do you have that are doing 36%? Now, there's risk here. Okay, we know there's risk. And part of the risk is up here. Part of the risk is the market could go down. Part of the risk is you have a stock that goes down a lot more than you think, or you have leaps that go down closer to your strike price. There's lots of risk, and you have to learn how to handle those risks. And you have to learn how to have a trading plan. And everybody should have a trading plan. All right. If you want to learn how to do a little bit more of this, by the way, I've got a program I've got a mastermind group, which is, all of us get together once a week, and we have an accountability call, we have a chat, we have all kinds of mentorship from me and the other people in the group. It's really, really great. But if you just want to take a course, and I suggest if you're going to take the course, you just go to the next level. But if you want to take the course, I have something in the description below called the Elite course. So just go to cashflowmachine.io/elite, and it'll tell you all about it. And I'd love to see you either there or in the mastermind group. We can have a lot of fun together. But I hope you're getting the idea, if you keep watching some of these videos, that even being conservative on a conservative strategy like covered calls is still a great way to make money. You don't have to try to hit it out of the park. You just got to make your 2 to 4% a month, and you're golden. I'll see you on the next video.